Okay, welcome back everyone. So we're going to continue with question 4.7. We've done adjustments 1 to 7 in the first session, and now we're going to go through the remaining ones. Okay, so let's start with entry number 8, which says rent income for September has been received already. Okay, so that means the rent for September 28 has already been received, and the rent premium has not been increased since the tenant moved in. So that means the rental amount remained the same. It's not like the one question we did previously where the rent has been increased by 10%, for example, during the year. And then you have to go use basic mathematical equations where you apply the previous rent as X, and then you would give the percentage that it increased 1 plus that percentage X to work out what the rental amount would be. So because of the fact that they're all the same, you do not have to wonder what the amount is been, and they tell you they've moved in on the 1st of September 2007. That means they've been there for an entire year, plus this 1 month they've paid in advance, which means it's 13 months that we have already paid. Okay, so we've paid 13 months. So that means if we've already paid 13 months worth of rental income, it is 1 month is income received in advance. So now what we have to do based on that, I'm just going to abbreviate. See if I can fit it in here. Okay. So that means 1 month is received in advance. So if you look at page 91, they tell you income received in advance is a liability. Now the reason it's a liability is because of the fact that if my tenant decides, or let's say the building burns down at the end of August, the tenant isn't physically using their property in September. So that means I would have to pay them that money back. So that's why we show it as a liability. And the rental income amount is the income that we've earned will now have to be reduced. Now what that means is if you scroll up to your trial balance, this rental income amount here at number 7 would essentially then relate to 13 months worth of rent and not only 12. So that's how you then go and calculate what portion of the rental income needs to be reduced for our disclosure purposes. Now if we look at the journal entry, we would debit rental income or rent income. We would take that amount per the trial balance divided by 13. Now because they haven't increased it, it is a straightforward calculation where you just divide it by the number of months to get to the amount of 4,000. Then we credit income received in advance, and we said this is a liability account. So we credit that with 4,900. Now, because income received in advance is a current liability, so it means it will happen within the next 12 months. We also include that under your trade and other payables. Okay, so that is, okay, these are trade and other payables. So we included under trade and other payables as 4,900 Rand. And then in your income statement or statement of profit and loss, we would go adjust your rent income line item and reduce it by the amount we've received in advance, which is the 4,900, to show what the rent income for the 12 months our financial period should actually be, which is the 58,800. Okay, so that is rent or income received in advance. Okay, then if we go to entry number 9, it says an invoice for 4,300 was received Okay, so I received the invoice for 4,300 from Equitini Municipality for electricity, and it has not been recorded. Okay, so what do you think do we have to do with this? So I've already got an invoice for 4,300 for electricity, but I haven't recorded it. How should we reflect transaction number 9? Who can tell me? What will I debit? What will I credit? Okay, so I'm going to repeat it. For transaction number 9, they tell us we received the invoice 4,300 bucks relating to electricity, but I have not recorded it as yet. How would I reflect this in my accounting records? What will I debit? What will I credit? Let's start with the easy part of the entry. What have I actually spent money on? Or what have I already received? Okay, let me repeat that. If I've already received an invoice, it means I've already incurred that expense. Now, normally, if we did not give you any journals to do, how would you record this transaction? Where would we record it and which journal? Okay, let me repeat it. Transaction number 9. How would you account for it in our accounting records? Normally, I would capture this via one of the journals. Which journal would I capture this transaction under? Okay, can you guys just indicate if you can hear me? Just show me a thumbs up or a smiley face if you can hear me, because I'm not getting any response from you guys. Guys, can you hear me? Can you guys hear me? Are you still with me or have you left the building? Can you just indicate that you are still alive? Okay, so remember in first semester we've discussed these types of transactions. So because of the fact that I've already got an invoice, I would have normally captured it that's in your creditors journal. Okay, now because of the fact that what potentially has happened is I've already closed off all these journals and then I discovered this invoice somewhere between my documentation. So now I have to physically go record this transaction via my general journals. So as soon as you've got an invoice, a creditor has already given you an invoice. So that means I need to go account for the liability. Now we know it's for electricity, so my electricity expense needs to increase, as well as the liability, which is creditors control. So transaction number 9, we would account for as follow. You would debit your electricity expense and you would credit your creditors control because of the fact that we already received an invoice worth 1,300. Then for our financial statements, we would go update our electricity line item with the amount for the invoice to reflect what our electricity expense for the year should have actually been. And then under our trade and other payables note, which shows all our current liabilities, we go add that journal entry as well, and then you get to what the actual trade and other payables balance should be. Okay, so that is transaction number 9. So you see, if you don't understand what an accrued expense, a prepaid expense is, you would potentially take this item that is actually a normal transaction to the incorrect account. So you need to read very carefully what they tell you in a test, in an exam. Okay, if we then scroll to number 10, we said an amount of 2,000 was paid to DAS Transport. So we paid 2,000 to DAS Transport for delivery by rail for the inventory. And this was debited to office refreshment. So we accidentally took it to the incorrect account. Here you can see that. And the error has not yet been corrected. The trading inventory to which railage relate has not been sold. Okay, so the reason that last sentence is relevant is because if it was already sold, you would generally have already accounted for it. Okay, if we did our perpetual inventory system, but because we're doing periodic, we only work out the cost of sales right at the end of the year. So that means the journal here is we need to just go take it to the correct account. So it was incorrectly put into office refreshments. So I need to take it out of office refreshments now. And then I have to put it into the railway or the railage account. So our journal for number 10 would look as follow. So to correct the error, I debit the railage inwards, so that is the account it should have been, and I take it out of the office refreshment where it was put in error. Okay, to correct that amount. Now this railage inward account we will use to calculate the cost of sales. So if we go to your statement of profit and loss, we now adjust your railage inwards amount with the 2,000 Rand, okay, to give us the actual railage, and then our office refreshments, we take off the 2,000, which is journal entry 10, and that should give you an amount of 23,320. Okay, so we take it off here. Then if we look at transaction number 11. Now transaction 11 is where an owner takes trading inventory for their personal use. What account does it go to if it's for personal use? You can just type the account name in the chat function. If it's for personal use, where do I take it? If I use something for personal use, what is it seen as? What is the account name? If the owner takes something for personal use, to which account would I generally put it? Come on, guys, this is first semester work. Where do I take an amount that an owner takes for their personal use? To what account do I book it? What's the general ledger account name? Drawings, that's correct. So we take it to drawings. Now remember, drawings is always at cost. Okay, yes, owner's equity drawings, yes. Okay, so it's always at cost. Now they've given you the selling price was 202,325 Rand. And they tell you the okay, VAT is not applicable, so they've made it easy for you guys. Markup is 55% on cost price. Now we said if markup is 55 on cost price, then your cost price is 100%. Your markup is 55%, which means your selling price is 155%. Okay, now that means our sales amount, 245.20, is 155%. Now I need to work out the cost amount. I want to know what this is. So I would have to divide it by the 155% and then multiply with the 100 that I want to get to work out what is the cost amount that I will remove. So the journal for the drawings is as follows. You would debit drawings account and then you show me the calculation. So it's the 2,325. We multiplied with the 100 because we want to work out the cost. We divide it by 155 because that amount is represented by the sales amount. So you get the cost of that item that they've taken is 1,500. Now, what is very important in this instance, and I'm just going to highlight it red here so you can see, because we've got a periodic inventory system, I take it to the purchases account and not to the inventory account as I would under the perpetual inventory system. We will only work out the cost of sales once we have actually done the year-end procedures. Okay, so that means under the purchases, I now could deduct the 1,500, which I have actually used for the owner, or the owner has taken to work out what was the actual purchases amount for the year. And then our drawings amount will be increased by 1,500 to reflect the amount that the owner has taken, okay, to increase the drawings amount for our year. Then if we look at number 12, now our stock take revealed the following items on hand. Now, the trading inventory balance, this balance is corrected as part of your closing transfers. That is when we will account for that balance. And then the cleaning materials and stationery we bring in as a general journal beforehand. So the journal for the stock on hand would be consumable stores on hand, and then we reduce the cleaning material and the stationery with the amount we still have on hand. Okay, so when we do the disclosure, then we now go create an asset account, which is consumable stores on hand. It falls under your inventory. So if we go to the inventory note, we will then add the consumable stores we've created. The trading inventory will now be exactly the same amount as per the additional information. Okay, but we would correct that balance with the closing transfers when we do the trading account to get to what is our trading inventories total amount. So that amount then on your statement of financial position, that line item here, that amount should be exactly the same up here. Let's quickly see. Okay, no, it doesn't agree. Okay, so our trading inventory is that. Oh, sorry, I have the wrong line item. Trading inventory is up there. Okay, so that agrees to your note disclosure. And then your closing inventory balance is also shown in your calculation here. That we deduct to work out your cost of sales for the year, which is then the 555,000. So you start with the opening inventory, which is in your pre-adjustment trial balance. Then you go adjust any of the purchase of the railway inwards amounts based on the additional information, and then your closing inventory is generally based on the additional information you go deduct it to work out what is your cost of sales. Now, once you've calculated your revenue and your cost of sales, then you calculate your gross profit amount. So let's see what additional information we still have. Okay, so under point 13, we said provide for the interest on the mortgage loan. So it means we haven't actually accounted for it as yet. We still need to provide for it. We haven't paid it. So now you have to accrue for that interest expense. Okay, so interest is calculated at 12% per annum. Okay, so that means that 12% is for the year. On the 1st of March, 150,000 was paid off. So that means our balance in our trial balance is after that repayment has already been accounted for. They tell you there's no additional loans or repayments, and then after year end, our monthly installments is 3,300 each, will be repaid by the end of September 28, starting at the end of September 28. Okay, so that information, the monthly installments, that just indicates what is the current component. So what will I actually pay within the next 12 months? So this portion here is only for disclosure. What portion is current? Okay, so is paid within 12 months. Now let's see how do we work out the interest amount. Now what I normally do is you create a little timetable like this. It's just to help you guys with documenting all the information. So what you do is you indicate the beginning of the financial period and the end of the financial period. So this amount here comes from your trial balance. So if we go to our trial balance, let me quickly show you where you would have seen this. You go to your mortgage loan line item. We can see the balance currently at the end of August is 357,750. Okay, so I go account for it at the end of August. Now I know they made a repayment based on the additional information on the 1st of March. So on the 1st of March, that's directly after the payment, this amount would have been exactly the same. But before that date, it would have been 150,000 more. So to work out the opening balance before we made that repayment, you take the balance at the end of the year, you add the 150, and you get the balance that was in the beginning of the year would have been 507,750. Now, the reason I need that information is because the interest would be accrued on the outstanding balance for the time period that it was outstanding. So when you do the calculation then, You go account for the 507. You say, okay, fine. From the 1st of September up to 28 Feb, which is directly the day before the 1st of March. If I now go count how many months, it is September, October, November, December, January, February. So it's 6 months. So how I would calculate the interest is I would take the 507, multiply with 12%, multiply with 6/12 to give me the interest balance of 30,465. Then for the remaining 6 months, I would then go work out the interest amount on the 357,750 to get to 21,465. And then when I add all of that together, the total interest I would have paid or need to pay would be 51,000. Now, because I haven't physically paid it as yet, I would accrue for that expense. Okay? Now, we said when we accrue for an expense, it is a liability because I would still have to pay the bank that amount. And then I create interest on mortgage loan, which is the expense relating to the interest that I need to account for. So then when I go to our accounting records or our financial statements, let's start with the liability first. So we've got an accrued expense here, which is also the interest on mortgage loan, which we add on here. So our total accrued expense for the year is 54,390. Okay. Then the interest on mortgage loan, we also got a note for interest expenses. So we account for it here until your interest on mortgage loan, and the interest expense, this was already given to you on your pre-adjustment trial balance. So then I can go update this amount here in my statement of financial profit and loss. Okay, now I've done all the journals up to 13. Now if I do number 14, we said owner made a capital contribution of 100,000 during the year, and this has been properly recorded. So I don't have to do a journal for that. Where I would need to take this information into account is when I do the statement of changes, and I need to capture here 100,000 because they've actually said that we've made a capital contribution in the beginning of the year. Now, because of the fact that we've made a capital contribution in the beginning of the year, that would mean, or during the year, that would mean this capital amount in here includes the additional amount, that 100,000. So when I then go do this calculation, I need to subtract it off here. Additional information, so it's the amount given less the 100,000 will give you the 599. Okay, now let's complete the rest of the question based on what's on the trial balance. So we've done all the additional information journals now. So now we go look at, let's start with the income statement. So we've got revenue, we finished the cost of sales. So we've already done 3 of the incomes. Now we have to do interest income. Now if you scroll down to note number 1, it is made up of interest income on your debtors account. Now if you look on page 148 in your textbooks, the interest on fixed deposit is 8,500. So that amount is given to us. Okay, okay, sorry, I swapped it around here. Okay, so this should be 8,880, and this should be 6,080. Okay, so then the interest income on your debtors account, if you read it off the trial balance, is 6,080 Rand. It hasn't changed. So if I add that all together, my interest income should be 14,660. Then I add all of the other income together, so I sum it together and then we get our gross income. So that is our gross profit plus additional income gives us the gross income. Then we go to all the expenses. Now we've finished the telephone and fax, credit losses, so we've adjusted all of the expenses so far. So for the other expenses where no adjustments are made, you can then literally just go transfer those amounts into your columns. Now in this scenario, I've just added a 0 if there was an adjustment to show you that there wasn't any changes to that. So then you go update the last expense amount and you then total them to get your distribution, administrative and selling expenses. Now let's say you are running out of time, you do not have time to do all these subtotals. Then just write these amounts because you generally get marks for this. And then just go work out the total amount by adding everything together. And then forget about the subtotals because you won't lose too many marks if you skip that. Okay, so then based on the gross income less the total expenses based on what was left over, our profit for the year is 295,000. Then we deduct the interest expenses based on note 2 to work out that our income for the year is 237,000. Now our comprehensive profit, as it is a positive, it's a profit, would equal in our statement of changes would equal what we've calculated to work out what is the capital at year end, which is the 931,000. Okay, so that is how you do the statement of profit and loss, statement of changes in equity. Now, if we go to the assets one, now we have to go look at, okay, fine, we've done the property, plants and equipment already. If we look at financial assets, we go to note 4. Now, I told you financial assets is basically fixed deposits or any cash amount that will only be received after 12 months. So in this scenario, it is our fixed deposit from Das Bank, which was 85,000. There was no adjustment to it. We just capture it as is, and then we transfer that 85,000 to our statement of financial position. We show it up here. Now, once you're done with all your non-current assets, then you add the total together, which is these two, will total to 1.4 million. Then we've accounted for inventory and then trade and other receivables and cash equivalents that would tie to the notes 6 and 7. So if we scroll down to 6 and 7, so now we've captured everything, but if you go through the list, there was still an account rent deposit, which we needed to add on here. Now, rent deposit is shown as a current asset. As soon as your tenant moves out, you have to repay that rent, so you show it as a current asset. So we add it to the rest of the balance. So our trade and other receivables is 40,780. And then cash and cash equivalents, if you go through the rest of the trial balance, there was a cash flow and petty cash that you had to add on here. There wasn't any adjustments on those. So they were also based on the pre-adjustment trial balance to get to a balance of 33,495, which you then include at the top. Now, similar to your non-current assets, once you've shown all your current assets, you add them together to get to 103,000. Now, if I add the non-current and the current assets together, I get to a balance of 1.5 million. Now, that 1.5 million, once we've done the equity and liabilities, that amount here should be exactly the same amount as here at the bottom. So let's start with the owner's equity. We said this one would agree to what we have in our statement of changes and equity. So I'm going to make that green. And then it would agree to what's in here. The statement of changes in equity, that balance, and the balance you disclose in your statement of financial position should be exactly the same. Now, let's say you've already done the statement of changes in equity. Go put that amount in there. If you made an error, you still get a method mark for transferring it into your statement of financial position at the same amount. Then the next item is your mortgage loan. Now, if we look at the additional information, I told you that for disclosure purposes, they tell you that 3,300 is per month and will be started to be paid end of September for the next 12 months. So we know those are a liability that will be settled within the next 12 months, and according to our rules, anything that will be settled within 12 months, whether it's an asset or liability, is seen as current. Now, what that means is when we look at the disclosure now, if I go to the note disclosure, we know the mortgage loan based on the information per the trial balance is currently sitting at 357,750. Based on the additional information, I need to go remove the short-term portion out of it, which is the 3,300 multiplied with 12 to work out what is the long-term portion now. So the long-term portion, that is the portion that will be paid after 12 months, is 318,000. So when you look at your statement of financial position, you'll see I've got a note number 8 for both of those line items. So your short-term portion is the 3,300 multiplied with 12, and then the remaining balance goes to the long-term borrowings and the non-current liabilities based on that note disclosure. And then similar to what we've done on the other side, if you've got all your non-current liabilities, you total that amount. Okay, so now short-term liabilities, the only thing remaining is our trade and other payables, which relates to note number 9. And if we add all of this together, you've got 1.5. So you can see that and that agrees. There's no difference. So I know my accounts are balancing. I've accounted for all the debits and all the credits in my financials. Now let's just scroll down to note number 9. The last outstanding stuff was SARS account. We had to add that on there, and there was a credit card account that needed to be added to get to the balance of 227. Now, let's say you missed the SARS or the credit card amount. What would have happened is this would have been short, which means this balance would have been less than that. Then you know you've missed a few accounts. Then you need to go back to your trial balance and see which accounts have you not included. So what I normally do in a test is I would generally tick it off. Take a pen and tick it off as you account for it so that you know you have disclosed it in your note disclosure, in your financial statements, so that when there's a difference that occurs, you know, okay, I've already accounted for it. Now, another trick we generally do, if you've got a difference and you divide that amount by 9 and it gives you a full amount, it means you've done, we call it a transposition error. It means instead of typing 76, you potentially typed 67. Then you also know you need to go look what you need to go look out for. Okay, so this is how you would do the note disclosures for your financial statements as well as your financial statements, the face as we call it. So the statement of financial position, statement of profit and loss and other comprehensive income, and statement of change in equity. Okay, do you guys have any questions on question 4.7? Do you want to type any questions you have on this question in the chat function for me? Do you have any questions on question 4.7? Is there anything that you're unsure about? You need to ask me. They will ask you this in the test. Not necessarily this bigger question, but you would get components of this in your test. So we need to make sure you understand this. Okay, guys, do you have any questions? Is there anything you're wondering about? Is there something I need to just clarify for you? Can you just put an emoji so I can see where you're at? Where's your mental space at? Are you okay with what we've discussed? Are you unsure about something? Okay, so I see 2 of you are present in class. What about the rest of you? The rest of you, are you okay? Michaela, no dear. Pops, Vasitsana, Donovan, Neil, are you guys all right? Do you understand what's going on? Orifa, okay, so what we're going to do is let's take a 15-minute break. I think this has been a bit of information overload. So if you can be back at 10, then we'll start with question 4.11. So if you can just page to that question in your text box. So I'll see you guys at 10 again. Okay. If you've got questions, just put them in the chat function. Otherwise, I'll see you guys at 10.